So let's start the lecture here. Um, One thing that I wanted to emphasize before we move forward, okay, these four accounts, they all have the same word in it. What's the word that's common in all four of these? Rent, okay? See if you can identify what types of accounts each of these are, okay? They all have rent in them. So see if you can identify, is it an asset, liability, revenue, expense, dividend? Okay. This is going to be a key skill. You're going to have to, as we see transactions, you'll have to figure out what accounts are involved, what types of accounts they are, and what's happening to them, if they're going up or down. So this is a little concept check to see if you're understanding what the different types of accounts are and you can identify them. So just take a minute, see if you can do that. It says prepaid rent. Yeah. I think you got the best seat in the house. Okay. Who wants to help me? What's number one? Okay, who votes that it's an asset? Okay, who votes it's a liability? Revenue? Expense? Expense? Okay. Okay, so who wants to advocate for asset? A lot of you raise your hands. Um, what about you in the back? Yeah.
Oh, I think it's an asset because it's something that you pay for, but you haven't used and it provides for future benefit.
Okay. Does expense want to rebut that? But it's okay, so the key word is prepaid, right? So let's say I have 1 year of my like lease. If I pay all of it up front, okay, I don't have to pay. I'm gonna get a year of benefit from that, right? If I pay the rent is for last month, I agree with you, it's an expense, right? But the fact that we're prepaying it, and we're gonna get the future use for a year of that property, I agree. You get a future benefit, so it is an asset. Okay, so again, I'm trying to emphasize, you got to get this straight. An expense is for something that's already happened. You're paying for something that's already done. An asset is going to give you future benefit. Okay, so if I paid my 1 year of rent up front, I can stay in that property for the whole year. I don't have to. Each month, I'm going to have an expense. We'll see how that works. Where as uh, you pay it up front, but each month it kind of gets eaten up, right? You're using some of it up, right? So as it gets eaten up, you're going to expense that, and we'll see how that's done later. But when you first prepay your rent, you have that amount of time as a future benefit. So it's an asset. Okay, what about rent payable? Who thinks it's an asset? Raise your hand. Okay, nobody. Good. Liability? Okay, yes. Payable, right? That's like the key word there. It means that you owe rent to somebody, your landlord. Okay, so that's a liability. It's any amount that you owe. That's or any cash, services, anything that you owe to someone else, that's a liability. So rent payable is a liability. What about rent expense? This should be obvious. Expense, right? This is for when you've already lived in the place for a month and then you pay for it, right? That payment is for the time that's already gone by. And then rental revenue, right? So the key thing I'm trying to emphasize here is there's no single word that's going to tell you what an account is, what type of account. You have to use your brains, understand what is this account trying to capture? What is what is that balance? What is it representing? Okay, so you're gonna have to apply your understanding of the definition of assets, liability, revenue, expense. It's not going to always be obvious. These last two are obvious. The words are written there as to what type of account they are. Okay, but it's not always going to be obvious. Okay. All right. Any questions on this? No? Okay. Um, I just wanted to re-emphasize this system of debits and credits. The claim was that assets equals liabilities plus equity, right? This equation here, which is in its full form, right? Where we have the full kind of build out of equity, which is all this stuff here. This is all part of equity. Now, you can think of it, our systems of debits and credits is the same thing where we're saying the debits, the left-hand side, balances are going to equal the credits, okay? But of course, we saw that there's two of these accounts that are a little weird because they have negative signs. Okay, so when we move it over, we get assets plus expenses plus dividends equals liabilities plus contributed capital plus revenue. Okay, and these three are debit normal, meaning that when they increase, they're debited. And these are all credit normal, meaning when they increase, they're credited. Okay? And so if you follow this system of debits balancing credits, it's going to make this equation balance too. Okay? If we are consistently applying that this idea of every transaction, our debits are going to equal our credits, the end game will be that this equation is also going to balance. That's how they fit together. Okay, and of course, if on these right hand side ones, if it's debited when they increase, it's credited when they decrease, and it's the opposite here. If they credited when they increase, they're debited when they decrease. Okay, so this hopefully you can relate which accounts are debit normal, which accounts are credit normal by remembering this the basic equation. Okay, it's derived from that. Okay. Okay, any questions on this? So then we moved on to this table, which is saying the exact same thing. It's just in a tabular format, right? So now you're gonna have to either remember it from that first principles that I just showed you, or you're gonna have to memorize this table. Eventually, it's gonna become like by the end of the class, you'll hopefully be very comfortable with this system. Okay, well, so you'll remember if I'm receiving cash, I'm getting it's a debit to cash. If I'm borrowing and I have a new liability, that's going to be a credit. Okay, you're going to do enough journal entries, again, repetitive nature of the class, you're going to basically have this memorized by the end of the class. But for now, you're going to have to work with it. Okay, any questions on this table or how it's related to what I just spoke about? Yeah. Okay. Yeah. Can wait a second. Okay. We talked about debit and credit as related to our bank accounts. I think we already did that, so I'm not going to redo that. But if you remember, it's basically the bank has a liability to you when you have a checking account with them. So whenever you deposit money, it's increasing their liability to you, which is why it's a credit when you put in money to your bank account. And then when you withdraw money or use it up, that's going to be a debit to their liability, right? So we saw here liabilities, when it increases, is a credit, meaning when you put in money, they owe you more. When you take out money, they owe you less. So it's going to be a debit. Okay. So that system is directly related to the system of debits and credits. Okay, so now how are we going to organize? Because we're going to have a bunch of transactions happen, like with cash, right? We saw from the homework that cash had many things happening to it. When you issued stock, you had cash coming in. When you paid expenses, cash went out. So cash is going to have, in this example, a bunch of debits, a bunch of credits. We're going to use this thing called a T account to organize it. Okay, so you can see here that basically this is the debit side and this is the credit side. Okay, so you can see if you add up all the, these are coming from different transactions. Maybe this $30,000 debit came from issuance of stock. Your company issued stock, it got $30,000 of cash. Maybe this $20,000 is some purchase of, you bought some equipment, so your cash went out, right? So these numbers are coming from transactions, and they're either a debit to cash or a credit to cash. And so at the end of our period, we're going to have some balance in cash. Okay, so you can see that the total debits are 35,500. I'm just adding these two up. And then the credits are 23,200. So my debits exceed my credits. Do we agree? So that means my balance in cash is going to be a debit balance, because that debit side is larger than the credit side. So that means when you net all of it together, it's going to be a debit balance of 12,300, which is basically 35,500 minus 23,200. Okay, so any questions on this organization of this T account? Like what, again, this is the left side is debit, right side is credit. Yeah, exactly. That's exactly right. Yes. Okay, so now um, let's do a little practice. Okay, so I have a bunch of T accounts here. Your job is to figure out what the balances are. Okay, so it could be a debit balance, it could be a credit balance. So take a second, get your calculator out, and try to figure out all the balances, and then we'll do it together. Okay, so I basically have copied out all the numbers down here. Okay, it's the same. Yeah, maybe I need to add a couple rows here. Okay, so this first one, I think it was cash. Okay, I can just visually see that it's going to be a debit balance, right? You can just see that the numbers here are bigger. So I can just do sum, add up these, minus sum of these. And if it's a negative number, I was wrong, but it's not going to be, okay? So everyone got an $1,800 debit balance for that first one. Okay, good. The second one was account receivable. So I have the numbers all just copied down here. And again, I can just visually see that the debits are larger. So I don't have to really, I'm just going to put the balance in the right place, which is on the debit side. So it's the same thing. Sum of the debits minus sum of the credits. 5,050? Yes? Okay, good. Plant assets. Is it a debit or credit balance? Debit. Obviously, there's no credits, right? So it's a debit balance. So you just add up these two numbers. 7,600 debit balance. Okay, accounts payable. I can see the credit side is bigger, right? It's 3,500 on this side. This one entry is larger, so I know it's a credit balance. Okay, so it's these numbers here. I'm going to put it on the right side. Sum. I'm going to now start with the right side because I know it's larger. Minus sum of the debit side. 2,730 credit balance. Did everyone get that? Yes, if you didn't, then hopefully you're seeing what your mistake was. Okay, this next one, unearned revenue. Again, I can see that it's a credit balance just visually. So I'm going to add up the credits minus there's only one debit, 3,310. Okay, so this one, it's a little closer. I'm pretty sure the left side is bigger, but one thing in Excel you can do just to kind of get like a quick uh, sum is you just highlight the cells you want to add, and in this bottom left, you can see down here, okay, it's harder to see on this screen, but it says sum 10,070, sorry, 10,870, and this side is 9,916. So I know it's a debit balance just because I quickly just did a little sum here. But now I can actually do the calculation. Sum of this left debit side minus the credit side. Okay, 1,254 debit balance. Okay, so you should all be like very comfortable doing this, figuring out what the balance is, whether it's a debit or credit balance. Okay, and again, it's like not complicated. It's just adding stuff up and subtracting. Okay, any questions on this? Any confusions that anyone wants to air out? No? Okay. Okay, so let's keep going. So now we're going to tie all this together. We're going to have this process of journal entry and posting. Okay, so what does that mean? This is an example of a journal entry. Okay, so what are the different parts of this? Okay, uh, you're going to have a date. Okay, so we can see here uh, that there's a date. There's always going to be a transaction date. And it's important because remember, our financial statements have cutoff times, right? We're going from, September 30th to December 31st. And only the transactions in that day period are going to be included, right? So the date of the transaction is going to matter, okay? And a lot of games actually are played with shifting around transactions by companies. It's kind of a fraudulent way. If they want to boost revenue and they had like a bunch of sales in like the first or second day of one period, they'll like shift the dates to make the prior period look better. Okay, so the date of the transaction is very material. So make sure that you're paying attention to that detail. Every transaction has at least how many accounts? What's our cardinal rule? 2, right? So you can see cash and common stock are the 2 accounts involved in this transaction. And our other cardinal rule of debits and credits is what? Debits equals credits in every transaction. So you can see here, cash is being debited. Does that mean cash went up or down? If it's a debit to cash, up, right? Debit, cash is an asset. Assets are debit normal. So when they increase, they're debited. So this means we're receiving cash. That's why we would debit cash. Why are we receiving cash? Because we're crediting common stock. Does that make sense? What kind of account is common stock? It's contributed capital, which is what? Is that credit or debit normal? Credit normal. So that means when we issued these new shares were created, common stock account went up. Since common stock is credit normal, it's credited. So this is consistent. This transaction is consistent with our rules of debits and credits because the cash going up is debited, common stock going up is credited. So that's consistent with those types of accounts. There's at least 2 accounts involved. And in this transaction, the debits equal the credits. So we're happy with this. Okay. And this, what we call a journal entry, is capturing this transaction. Okay. And there's also a little explanation. You can see there's a little memo here that says what the transaction was for the issuance of common stock. Okay. So again, the cardinal rules is that there are at least 2 accounts, right? This is this first rule down here, and that the total debits and total credits are equal. So it could have been that, if there's 3 accounts involved, there could have been, 1 debit for 30K, 1 credit for 10K, and another credit for 10K. But in this case, we're still obeying our cardinal rules. There's at least two accounts. There's actually three, so there's more than two, but there has to be at least two, and the debits equal the credits. Okay, so we're going to see again, there are transactions that will involve many accounts of different amounts, but the debits and the debits will equal the credits in total for each transaction. Okay, all right. Any questions on this journal entry? Okay, so what do we do with the journal entry? So this is the process of kind of updating the account balances after each transaction. Okay, so here is our kind of step-by-step process for what we do during an accounting period. Number one, when we have the transaction, we identify what accounts are involved with it. Okay, so this is identify the accounts, determine what type of account they are. Is it an asset, liability, revenue, expense, dividend? And make sure there's at least two accounts involved. Okay, that's the first step. The second step is you determine, are those accounts increasing or decreasing? What's happening to them, right? So when we issue stock, we've identified that cash and common stock are the two accounts. Cash is an asset, common stock is contributed capital, which is, I guess I should have included that here, contributed capital. Cash is increasing, common stock is increasing. Okay, so we've now kind of done step two, and then we apply the rules. Cash asset increase, debit. Common stock contributed capital increase, that's a credit. So now we're kind of we're ready to do our journal entry. So then we do the journal entry, making sure that the total debits equal the total credits. Now is the next part that we're getting to, posting it. Okay, so we basically are going to split this journal entry apart and update the T accounts for each of these. Okay, so you can see that this cash, that 30,000 is going to end up as on the T account on the correct side, right? Debit. This is on the debit side of cash. Common stock is getting credited, and we're going to make sure that this is getting what we call posted here to the credit side of common stock. Okay? So now we have an updated balance for cash and we have an updated balance for common stock. And so we're going to just go through all of our transactions. We're going to keep doing this where we have a journal entry and then we update our T account. Journal entry, update our T account. Okay, and by the end of the period, just like we had up here, we're going to have a bunch of stuff happening to cash, and then we'll get a balance at the end of the period, right? We'll have all the transactions kind of accounted for, and then we'll calculate the balance. And that's how much cash our business has after all these transactions have taken place. Okay, so let's just do some examples. Okay, so I'm going to do this. I think it will be kind of useful to see this done in the accounting software. Okay, so it's called Wave. It's like free. So if you guys ever wanted to mess around with this, you can download it. But I've kind of already started a fake business. Okay, I already have one transaction here where I receive cash for common stock. So you can say this is the first transaction of the company. Okay, so now let's see what happens as I do different transactions. So on October 4th, I purchased office equipment for $10,000 on account from Office Depot. Okay, so what accounts are going to be involved here? Let's just kind of do the brain work ahead of time, and then I'll show you how to do the entry in the software. Okay, office equipment. What else? Sure. Okay, so on account. See, I didn't pay cash for this. So what account is this? What have we been calling this when you buy something on credit? Right? Accounts payable. Everyone agree? Okay, so those are my two accounts. Office equipment and accounts payable. Is office equipment going up or down? Am I buying or am I selling office equipment? Buying. So office equipment is going up. It's an asset. So is that going to be a debit or a credit? Okay, so good. We have debit office equipment. I'm just going to call it OE 10,000. Okay. What about accounts payable? What kind of account is that? It's a asset, liability, revenue, expense. It's a liability. Good. And is it going up or down? It's up, right? Because I now owe Office Depot 10,000. It's a new liability that just got created. So that's gonna be a credit. Okay. So if I go to my software, if I go to add transaction, there's different ways to do it. Okay. The modern accounting software, they're like integrated with your bank account, right? They'll download all the bank account transactions that you have. So if it's coming from your bank account, what is definitely one account involved in every transaction in your bank account? I heard it kind of whispered, but say it with some confidence. What is your bank account? What is that? What kind of asset is that? Cash, right? So if this software is downloading all your accounts from your bank account, at least one of the accounts is cash, because that's where all that data is coming from your cash transactions, right? And then you would go and like sort it and say, hey, that $10,000 cash was to buy office equipment, right? So in this case, I'm going to do a journal entry, right? Because I'm just going to do it from like without any data feed. Okay. So what account? Okay. So first it's like, I guess I said it was October something. So let's just make the October 5th. What was our account date? October 4th. Okay. So I'm going to put the date, October 4th. I'm going to put, let's see if I have an office supplies. Let's see if I have an equipment. Equipment. Okay. So I'm just going to use it. I'm not going to call it office equipment. I'm just going to put equipment. We said it's a debit, 10,000. And then we had accounts payable, right? So you can see here the drop down is telling me it's like kind of listing it by type. So I can see liabilities, accounts payable. Okay, so now it's going to let me do this because my debits and my credits are equal, and the accounting software knows that that's like the cardinal rule. Okay, so I can go save. Okay, so now let's see. So now you can see it appeared here. It says category journal entry 10,000. So if I go to look at my balances for my accounts, okay, account balances, you can see that, oh, it's because the dates. You can see that I now have two assets, cash. That's from that first issuance of stock. I have $10 million in cash. And now I have equipment, debit balance, 10,000. So this is my total assets. Accounts payable, I have a credit now, 10,000, and then common stock credit balance 10 million. Okay, so that journal entry updated the balances for these two accounts. Okay, let's see if there's a better. Maybe there's a. Maybe this is going to show it. Yeah. Okay. So this is a little better view. This is more akin to our T accounts. Okay. Um, you can see here, I have to keep altering the dates because it keeps wanting to just do the month of. So this is kind of like the T accounts for everything, right? Cash, debit, 10 million, and the balance is just a 10 million balance. Equipment, debit balance, accounts payable, credit balance, common stock, credit balance. Okay, but you can see that it all balances. Okay, so this is a little preview of a different report that we have called a trial balance. You can see that the total debits. Oh shit. This is going to be annoying. I have to change the date every time just to get everything included. You can see that the debit total 10 million, 10,000 is equal to the credit total. Okay? So this is going to always, we saw in chapter 1, that very tedious problem. The balance is always going to be maintained. Okay? Okay, so let's do the next transaction. So performed consulting services for a client and received $4,000 cash. So what accounts are involved here? Okay, I heard it. Whisper it. Who wants to raise their hand and tell me the two accounts involved? Yeah, Chris.
Would it be cash and
Yes. Cash. $4,000 cash you received. Cash is an asset. It's going up. So what is that? A debit or a credit? Debit, right? So we know we're going to debit cash 4,000. And Chris said service revenue. We're earning revenue. Is that a credit normal or a debit normal account? Yeah, service revenue. Credit normal, right? Let's go back. Let me just make sure we're all seeing where that's coming from. It's from this accounting equation. Okay? Right? Revenue is on this credit side. So that means when it goes up, we credit it. Okay? Everyone good with that? So debit cash 4,000, credit service revenue 4,000. Agreed? That's our journal entry? Okay, so let's do that. So I'm going to go back to transactions. I'm going to add another journal entry. I'm going to say cash 4,000 debit, and then service revenue. So it's calling this income, okay? It's an income account. That's what this software is calling it, but it's a revenue, income, same terminology, okay? And this is going to be 4,000. Again, now that my credits and my debits are equal, it's going to allow me to save this because it's and then let's make sure the date. I think it was October 6th or something. What did I say? Oh, shit. October 8th. Okay, so now I'll save this. Okay, so you can see now this transaction ledger is keeping track of all the transactions. So this journal entry 4,000 is going to appear here. And yeah, I could write, service revenue, and you can maybe say your client name, client X. Okay. Okay, so now let's see that appear in the balances. Okay, so you can now see under service revenue, we now have a credit balance here, 4,000, and the cash balance went up too, right? We got this 4,000 in cash that came in. So it's automatically posting it, right? We talked about this idea of posting, where we have the journal entry, and then it goes and it updates the balances, right? It kind of puts the debit or credit in the right spot in the account. So this software is automatically posting it, okay? That's why you won't actually have to ever deal with T accounts. The software is managing the T account for you. But you need to understand the link between the journal entry and how that account balance gets updated, okay? Okay, let's do another one, okay? Paid $1,500. Let's skip that one because that's just another cash. Okay, what about this one? October 20th. We paid $5,000 cash towards the equipment we purchased on the 4th. That we remember we bought that on account, right? Okay, so what are the accounts involved? Who wants to help me? I'm gonna do a seating chart. I'm gonna give you a warning on Wednesday because I need to learn your names. I could point at people, but I'm gonna do a seating chart. So like, figure out where you want to sit on Wednesday. I'm probably gonna do that. But yeah, it would be nice, I will cold call people once I have that seating chart, especially. So if someone wants to volunteer, you can bail your classmates out. of getting cold called. And I don't like the same people answering every time because I know you guys know the answers. So I'd like to mix it up. So maybe I'll just point at some random people. What about you?
I honestly wasn't paying attention. I was reading through it.
Okay, respect the honesty. But you should, because this is why you're here. You can read your emails later. Okay, anyone else wanna? Yeah. Okay. So is cash going up or down? Down, right? That cash is leaving our business. We're paying off this payable. So is that a debit or a credit? Good. Yes. So cash is going to get credited. So we know that we're going to debit something, right? So does it make sense to debit accounts payable? Is that right? Okay, why is it right? I agree with you. Yeah, right? You owed that money, but now you're paying it off, right? So you owe less money to that person. So yes, it makes sense that that liability, accounts payable, is going to go down. So you should debit it. Okay, so we just figured it out. This is our journal entry. Uh, Debit accounts payable, 4,000 or 5,000, credit cash. Okay, so let's do that journal entry. And it's on October 20th. So go back, transactions. So I said accounts payable, 5,000. You notice we're not paying off the whole thing, right? I think it was 10,000, right? So we're paying off half of it. We're on like a little payment plan. Okay. So we're going to pay off half of it. Okay. So I'm going to save this. Let's go back and see what happened. Okay. So you can see with cash, oops, the date of this. Let me fix that. Okay. So let's go back. Okay. So you can see here now, like, let's look at our cash T account essentially. Okay. We have two debits, 10,000 or sorry, 10 million from the issuance of the stock, that first transaction. Service revenue, we got cash from that client. And then this 5,000 is a credit, right? It's a reduction in cash, right? So it's giving us the balance here, right? It's not telling us. This software is a little it could be a little more clear by telling us that this is a debit balance, but it is a debit balance. Okay? And then equipment, we have our 10,000. And if we look at accounts payable now, we started with this $10,000 credit. We just debited it, right? So this $5,000 debit and this $5,000 credit are from the same transaction, but they've now kind of been split into their respective accounts. Okay? And they're linked together. You can see the date is the same, right? October 20th, October 20th. So you looking through the T account can figure out what the full journal entry was. Okay, so yeah, the balance here is 5,000. Again, it could be more clear. It's a credit balance, but it's coming from this credit and this debit. Okay, any misunderstandings or confusions that anyone has right now that we can talk about? Because if you do, you're probably not the only one. So I would ask now. Okay, this system is like it's tight. It's a tight system. Okay, in the end, you can do 1,000,000 transactions, and in the end, this will still have your balance sheet balance if you just keep doing it the way that we're doing it, even if it's 1,000,000 transactions. So the symmetry of this, it's a very elegant system. Okay, um, but you have to do it right. You have to make sure you have two accounts involved, that your assets are debited when you increase them, credited when you decrease them. So you have to know the system in order for this to work. Okay. But if you do know the rules and you apply them consistently, your books will always balance. Okay. Um, okay, so let's do some practice with this. Okay, let's open up the Excel sheet for the in-class work, and if you open it up, you're gonna see that there's a bunch of yellow tabs at the bottom here, and before the first yellow tab, there's this one that says transactions. Okay, so it's just a list of a bunch of transactions, and what we're gonna do is basically apply these rules that we just learned, and we're going to do a bunch of journal entries. Okay, for all these transactions, you can see on April 1st, this company uh, received cash from issued common stock. Okay, so you're going to go through, you're going to figure out what accounts were involved, what type of account they are. Are they going up or down? Are they debited or credited? And then, this makes it a little easier. There's drop downs and stuff to pick the accounts. So the first step is to do this enter answers 1 tab. Okay, this first tab, and that's what I did was I took these transactions which are on the different tab, I just copied them, and then I pasted them right here so I could have them in one sheet. So I would do that if I were you. It'd make it easier. Okay, so I'm gonna turn on the lights, and we're gonna work on this for a good amount of time today. Okay, so let's just try that. Okay, so on April 3rd, the company paid cash for land. Is cash going up or down? Down, right? Cash asset going down, that's going to be a credit. So I'm going to credit cash, and I'm going to debit. What am I getting for that land? Or sorry, for that cash? I'm getting land, right? So look, I think there is some confusion. Again, you need to make sure that you're understanding the difference between buying an asset and paying for an expense. Okay? Just because cash leaves your company doesn't mean that there's an expense. Okay? This is a case where you're trading one asset for another. You're trading cash for land. Okay? If I had been paying, whatever salary expenses, this would also be a debit. Okay? This could also be a coherent journal entry because expenses are debit normal. If you go look back at how what is debit normal, what is credit normal, but in this case, it's not a expense account. It is a land, and we're just trading one asset for another. Okay, so you need to understand that just because cash leaves doesn't mean it's an expense. Okay, we're also spending our cash to buy other assets, and we're just trading one asset for another. Okay, next one, we purchased office supplies on account. Okay, so I'm receiving office supplies, and office supplies are what? An asset? What are they? Yeah, they're an asset, right? Let's just not play that game. 1250. It's an asset. Now, if I had paid cash, hypothetically, this would be a perfectly valid journal entry, right? Because cash is going down and I would credit it. However, I'm not, and I have accounts payable, okay, which is also a perfectly valid journal entry because it's a liability and liabilities are credit normal. Okay, so let's just now post these two. Okay, so land, debit, 225,000. So I go here to land and make sure I'm on the debit side. I debit 225,000 to land, and then I credit 225,000 to cash. And you can see it's automatically doing it. It's calculating my balance for cash automatically. Okay? And then the other one was office supplies, debit, 121,250. So office supplies, debit. And then, where is it? Accounts payable, credit. Okay, so you can see here in this little debit credit check, we're balanced, right? This little corner right here, you can see that we have a balance. Oops. We can see that we're balanced. If I had messed up, okay, let's say I'd put the credit to account payable incorrectly, you could see that I would have thrown this balance off, right? So this spreadsheet is set up in a way to help you avoid a mistake. Okay? April 6th. Let's do a couple more. We provided IT services for a client and collected cash. So cash obviously is one of the accounts. Is it going up or down? Up, right? I collected uh, revenue from a client, 12,000. And I kind of gave away. What is the other account involved? I just kind of said it. What did I do in this transaction? I provide service, right? So what do we call that when we earn service revenue? Correct. Okay, so let's post this. Debit to cash, credit to service revenue. Okay, so we're still balanced. Okay, April 7th, our transaction 5. Redmond provided IT consulting services for a client, and the client will pay us in the future. Okay, so it's going to be the same credit. It's service revenue. We're doing kind of the same action as before, where we're providing services to our clients. However, they're not paying us cash right away. So if we did collect cash, it would just be pretty straightforward. We would debit cash just like we did in the last one. But they're not paying us yet. What is it called when someone owes us money? Accounts receivable. What kind of account is that? Is it an asset, liability, revenue, expense? What is it? Who thinks it's an asset? Who thinks it's some other kind of like one of the equity accounts? It's for sure, yeah, it's an asset. Okay. Okay, so then we post it. Accounts receivable, 14,000 debit. Service revenue, 14,000 credit. And we're still balanced. Okay, let me do one more. We paid cash expense on April 10th. Salaries, 8,000 and office rent, 5,000. So this is our first little taste of a transaction that is going to have more than two accounts. Okay, so what are the three accounts involved here? There's three. Who wants to help me? Yeah.
Cash, and then I did salaries expenses, and then rent expenses.
Exactly right. Yes. Yes. Salaries, expense, rent expense, cash. Those are the three accounts. Okay, so cash is going to go down, right? This is now money out the door. Okay, so I already know it's going to be a credit. And what's the total? It's 13,000. So I already have the cash part of it done. Okay, and then what do we say? Salary expense, and we said rent expense. Okay, and salaries is 8,000. Is that right? Is that right? Okay, so again, we're following our cardinal rules of journal entries. There's at least two, and the debits equal the credits. Right? Okay, so let's just now post this. So salary expense. Now I'm going to finally be into this section here. So salaries expense 8,000, rent expense 5,000, and I'm making very sure they're on the debit side because expenses are debit normal. I'm making sure I'm posting them in the correct side of the T account. And then cash. And I still see that my debit and my credit totals are balanced. Okay, all right, keep working. Okay, so I think we're caught up with the posting for all of these. So let's see. This one, transaction 7. So we paid $750 on the accounts payable created. Okay, so in transaction 3, we have this accounts payable. This is the amount that we owe. Okay, we're now going to pay off some of that. Okay, so I'm actually going to do it a little backwards just to illustrate my point. So this 1,250. What should it be after I make $750 payment? What should the balance be? How much would I owe? 500, right? The way to do this is I have a credit balance. If I just debit the amount of my payment, you can see that the balance for accounts payable goes to that correct amount I still owe. Okay? So I already have half the journal entry. I'm going to have to debit accounts payable. Okay? What did I use to pay off this debt? What do you use to pay off your debts? Your bank account balance, right? Your cash. So cash is going to go down $750. Okay, so let me post the other side of that. And I'm making sure that on cash, I'm making sure it's on the right side because that's the credit side. Okay, any questions on that? Everyone got that? Okay, all right, let's keep going. We collected $3,000 of cash. Okay, so obviously it's going to be a debit to cash. I already have half the journal entry done, right? Cash is going up because I'm collecting it. And it's from this client from transaction 5. So if you look up here, there is a receivable that was created, right? We did this service for this customer. We recognized the revenue at that time, right? But they're deferring the payment, right? So again, I mentioned this last time, I'll say it again. We've already recognized the revenue, okay? We've already kind of attributed our equity to this, like we've kind of boosted our net worth of our business already, right? Now it's just a matter of collecting the cash. We're just going to trade one asset called accounts receivable. That's going to disappear. And we're going to get cash in the place of that because in this transaction, that business owed us money. So we had this asset called accounts receivable that was created. They no longer owe us that money, right? They're paying us off. So that asset is going to disappear. It's going to go away. And in its place, we're going to actually get the hard cash. Okay, so I have two assets that are involved, cash and accounts receivable. One is going up, cash is going up. One is going down, accounts receivable is going down. And it was for 3,000. Now they didn't pay us off everything. They're just making a payment, right? So if I just post this, 3,000 debit to cash, 3,000 credit to accounts receivable. We now have the balance of how much they still owe us of 11,000. Okay? So that's kind of the beauty of the system too. All you have to do is just keep track of the payments and the balances will just automatically update to what their most current status is. Okay? Okay, so next. Is it this one? Yeah. Paid $8,000 salary. Okay, on April. Wait, did I skip some? Okay, yeah. Paid dividend 2,500. Okay, so I already can just put in the amounts. Okay, look, I know it's going to be a debit of something 2,500 and a credit of something for 2,500. Okay, the easy one is cash. Cash is going out the door. Okay, cash is going to be the credit. Agreed? When you pay a dividend, the cash from your business is going to diminish. The cash balance of the owner's personal bank account is going to go up. We call that a dividend. Okay, so dividends, that's a debit normal account. So it makes sense that when we pay a dividend, we debit this account called dividends. Okay, so this is a coherent journal entry in line with our rules of debits and credits. So then I'll post this. How much was it? 2,000? 2,500. So I'm going to credit cash 2,500, debit dividends 2,500. And again, I'm making sure that this debit credit balance is maintained, and it is still. Okay, so let's keep going. On the 18th, we prepaid office rent. Okay, so we just talked about this, right? Prepaid rent. What kind of account is that? There is a debate whether it was an asset or an expense. What did we determine it was? Asset. Okay. So when we have this new asset called prepaid rent, is that a debit or a credit? Debit. Okay, so we're going to debit prepaid rent. What are we paying the rent with? What is this? What are we giving to the landlord? Cash. So our cash is going to go down, right? So we're going to debit prepaid rent, credit cash. And how much was it? 15,000? I don't, just give us like, I'll give you like the last 5 minutes. Okay. Yeah, if you can just come in 5 minutes. Yeah. Okay, so I'm going to post that. So cash is going to be a credit, 15,000. And this prepaid rent asset is our debit, 15,000. Okay. Okay, so this one, Redmond paid 8,000 in salaries. Okay, so this is pretty simple. What are you paying the salaries with? Cash. Okay, so is that a debit or credit to cash?
Credit.
Credit. Cash. Debit is, we already saw this up here, remember? So this is the same, salary expense. Okay, so I'm going to post it here. Salary expense, it's getting another debit, 8,000. Cash gets credited, 8,000. Okay. We purchased a building. Okay, so we're purchasing a building and we're not paying any cash for it. We're taking on a loan for the entire purchase amount. Okay, so the building, what is that? Is that an asset, liability, revenue, expense? What is it? Asset. We're receiving it. So is that a debit or a credit? Debit. Okay, so 520,000 debit to building. Okay, and we know there's a credit, 520,000. What should it be to? Notes payable. Okay. And that makes sense, right? Notes payable is a liability. We have a new liability. It's going up. So that's a credit because liabilities are credit normal. So building, debit, 520,000. If I go to my liabilities, I see notes payable, credit, 520,000. And now, okay, so when you see these little number signs, it just means that the column is not wide enough to display the number. Okay, so what you can do is go to up here. You can drag the column a little wider. You can also just double click on the border. It will automatically resize the column so that it can display. Okay, so we see that we're still balanced. Okay, okay, so this one is interesting. Okay, so in the first transaction, our company gave common stock in exchange for cash. That's the most common way that owners will kind of get ownership in a company. In this case, someone is trading furniture for ownership. Okay, but the furniture has value. It's $25,000 worth of furniture. So it's essentially like in this first transaction, we have some asset, cash being debited because our company is receiving that, and our company is issuing new common stock. So it's the same thing, except we're going to debit a different asset. We're going to debit furniture, 25,000. In exchange, the owner is getting that value in common stock. Okay, so then if I go here, common stock, another 25,000 credit, and we're getting furniture, $25,000 worth. It's a debit there. Okay, cell phone bill. Okay, $1,100, and we're gonna pay this. So it's basically it's telling us to use utilities payable. So we already know one account. So if we have this new liability, should that be a debit or a credit to utilities payable? Who thinks? Well, what is utilities payable? Is it an asset? Is it a liability? It's a liability, and when liabilities increase, what are they? Is that a debit or a credit? Credit, right? So utilities payable will get credited. What should we debit? Yeah, expense, right? This is the cell phone company is sending us this bill because we've used a cell phone, and that's an expense for my business, right? I get no future benefit. I've already used the cell phone service. Okay, so that's an expense. That's the definition of an expense. Okay, so we're going to debit utility expense, or what is it? Cell phone expense, utilities expense, and we're going to use utilities payable of 1,100. Okay, and we have an announcement, so I'm going to just pause the lecture here. We'll finish the rest of this. Okay. And yeah, so we'll finish the rest of this on Wednesday.